Let's touch base with our special guest this morning. We have Marc Faber joining in to talk about his outlook for 2019. He's, of course, editor and publisher of the Gloom, Boom and Doom report. Dr. Faber, it's great to have you on the show. Thanks very much for taking out the time. U.S. markets have had a rough close to 2018. What's the outlook you can offer for 2019?
Well, I think that if we look at markets around the world, they have always been driven very much by the S&P 500. In other words, the S&P 500 goes up, the other markets go up, some more and some less. Like in 2017, all the Asian markets grossly outperformed the US and also European markets. In 2018, most Asian markets have underperformed the US. I have to say there is an exception, which is India, which has performed reasonably well. Not that well in US dollars, but in local currency, it's at least up for the year.
Right. But a large part of the concern is on the inversion of the yield curve in the US and the spread narrowing between the 2-year and the 10-year yield, suggesting that the growth momentum we've seen through 2018 may not sustain into the new year. What's your outlook on US growth?
Well, I think since the beginning of the year, if you analyze the statistics clearly, there was a slowdown in economic activity, and in particular, after August 2018, business fell like off a cliff. I mean, I've talked to some people in August, and they were still very optimistic about the future. And in November, they wrote that their revenues are 20% below a year ago and 20% below budget. In other words, they totally misread the economic slowdown that was going to take place in the second half. And this economic slowdown is actually visible in the performance of bonds in the US. If you look at the stock market between October, early November, and today, we're down, say, plus minus 10%, depending which index. Some indices are actually down from the peak 20%. But the bond market, the 10 years US Treasury, has rallied since early November by 10% to a high yesterday. I think we will now consolidate, but I'm just saying the bond market was beginning to recognize the economic slowdown earlier than the stock market.
Right. Mark, it's almost turning out to be one of those deja vus, if you recall the kind of fall that oil prices had in Jan to Feb 2016. And we pretty much are seeing the same kind of status, especially given how steep the fall has been in just the last 3 months. With oil now hovering around the $50 per barrel mark, what's your outlook? Because this, as a factor, is one of the key things that Indian market do take into account.
Yes, that is a very good example. Until maybe 6 weeks ago, people were still talking about $100 oil. And instead of going up, oil completely imploded. Within a very brief period of time, we are down like 40% from the peak. And concerning the oil price, I just like to say, when oil goes up, oil producers benefit, and when it goes down, oil consumers benefit. So India benefits from lower oil prices. The US, on the other hand, does not benefit because it has become a very large oil producer in their own right. So depending on the country, it has a favorable impact, and it has on others an unfavorable impact. In general, weak oil prices like weak copper, weak nickel, weak aluminum they signal an economic slowdown in the world, or they signal a recession.
So how is it that you're viewing the risk of a looming recession, especially for the developed markets into 2019?
Well, I think it's important to understand that we've had off the peak now on the S&P a decline of say 10, 12%. But we have to look at where we came from on the S&P. In 2009, admittedly an oversold level, and maybe an extreme level, we were at 666. Now we went to 2,940, that was the peak, and we're still at over 2,000. So I think I would be surprised if the S&P dropped to, I don't know, 1,500 or so. And normally, when you have this kind of momentum on the downside, in a market like the US, that is a very old bull market. We started the bull market March 9th, 2009, and we're now 2018 at the end. So I think what is happening here is that we could have a more meaningful decline that does not reach a new high anytime soon, but where asset prices, stocks, and then eventually also corporate bonds and real estate and art prices and collectibles and commodities, they all go down. We had this asset inflation since the early 1980s, and we could have an asset deflation that is with us for several years.
Is India holding its own versus other emerging markets? Does it look more attractive to you because we've had a relatively better year?
Yes, I mean, I think that the Indian market has caught the attention of foreigners. So there were big buyers of Indian shares at the beginning of the year. I think the reforms that Mr. Modi has implemented or is trying to implement are on balance very favorable. I think a lot of progress has been achieved in India. The only thing I have to say is the valuations of equities is not cheap. It's an expensive market. And if I were to bet on a market next year, or whenever the time will come, I will buy assets that are depressed, not assets that have outperformed everything else in 2018.
Can India continue to outperform EMs in 2019, you think?
Yes, for sure we have the potential. We just don't know. Maybe it will and maybe it will not, but it has the potential, that undoubtedly.
Right. Mark, a lot of people are assigning uncertainty to the big event for us in 2019, that is the general elections. But historic data seems to suggest that markets typically have actually performed better and outperformed after that bit of a knee-jerk reaction after the election event, and have actually held through in an election year. How critical do you think is election, and is it a big risk for India as we step into 2019?
I'm less concerned about the election than about the central bank. I think the central bank was under Mr. Rajan and Mr. Patel relatively independent. No central bank is 100% independent. I mean, I talked to many people who used to work for the central banks in the US and in Europe and so forth, and they all say essentially the government, the Treasury Department, and the Federal Reserve or the central banks are all one and the same. So total independence does not exist. But it was a relative independence, which I consider to be very important. And I think both Mr. Rajan and Mr. Patel, they pursued a policy of stability of the rupee, which I think for the majority of Indians is a very desirable policy. Is it necessarily very good for stock investors? No, because stock investors, they like money printing. So the stocks go up. That's their only concern. But as an economist, my concern is the well-being of the entire economy.
Okay, so what sectors are you looking to buy when it comes to India?
Well, personally, I have argued for years, if I were Indian and I lived in India and I could buy freely real estate, which I cannot do as a foreigner, then I would focus on investments in real estate, because India is in the early stages of economic development, not in every sector, but in many sectors. It's in the early stages of building a very large middle class, and then it becomes attractive to own a home, first a residence, whether that is nearby Delhi or in Delhi or Mumbai or wherever. And then the second thing is that these aspiring millennials and young people who have money, they want a second home. They want maybe a condo on the beach, or they want a house for weekends and so forth. So I think that real estate in India is still in the infant shoes of economic development. If you compare it to other countries, in China, real estate developments are far more progressed than and advanced than in India. So that is a sector I would look at personally.
What then is your view on emerging market currencies with the kind of pressure that we're facing on current account deficits?
Well, I think this is a very good question, because emerging markets have a high current account deficits in some cases, but not in all cases. And number two, by size, the US has, of course, by far the largest current account deficit and trade deficit. And I don't see any improvement. So, of all the currencies, if you ask me which one is the most vulnerable, I think the US has a very vulnerable currency. And as a result, I think that maybe next year you should be positioned in emerging market currencies. I think emerging markets have grossly underperformed the US. And on valuations, emerging markets are now becoming statistically relatively attractive. Now, if earnings, of course, collapse, then they are not particularly attractive. But relatively speaking, I think if you ask me to buy stocks next year, I would rather buy in emerging markets than in the US.
And within emerging markets, you would prefer India versus others?
Well, as I told you, in my view, Indian stocks are on the high side. This is what I said to you. And if I bought shares, I would buy the ones that have been hurt very badly. And so these shares would have, in my opinion, a strong rebound potential.
Okay, and how do you feel about stepping into 2019 versus how you were feeling about stepping into 2018? Are you more cautious into the new year than you were the same time last year?
Well, as 2018 began, I thought that by January the 26th, we had made a major high in the United States. And I call that the orthodox high. That is the high when the majority of shares reaches a new high. What you can have thereafter is another new high, but it's not driven by the majority of shares. As you know, an index, say the S&P has 500 stocks. In theory, 499 could be down by, say, 1/8, and one S&P stock with a big market cap like Apple could be up $10, and the index would be up. So it would look very good, but underneath the market, beneath the market, the majority of shares would be down. And so in October, November, we made new highs in the indices, the Dow, the S&P, the Russell 2000, and the NASDAQ 100. But the majority of shares did not participate. It was driven largely by the FANG and FANG-related stocks. And so I became quite bearish, in late September, early October, because the market's advance had not been confirmed by the majority of participants of stocks. It was the generals leading, the FANG and FANG-related stocks leading, but the troops behind, they were not following.
All right, Dr. Faber, we leave it at that. Wish you a very happy new year and a great entry into 2019.